Good morning and welcome back to Before the Bell with Roman and Zain. Today is Monday, September 8th, 2025, and I'm here with Zain, and it feels like this weekend didn't even happen because of all the headlines that kept on piling up as Europe's politics and rallying markets, and the OPEC is adjusting supply again, while corporate bonds are flying off the shelves. The kind of stuff that you just don't see every single day.
Yeah, Roman, this isn't just one of those weekends where you flip through and think, oh, not much happened. Each of these stories ties directly into money moving today. Currencies, commodities, equities, credit, the whole nine. And it's not just market noise, it's structural. Europe's credibility, the future of oil demand, how corporations fund growth, it's all in play. Let's go through a quick market rundown, all right? So markets ended last week a bit split. The Nasdaq still carrying momentum thanks to tech. Alphabet's antitrust ruling lifted sentiment there. The S&P 500 barely moved, and as to the Dow, it lagged with weakness within the industrials and energy sectors. Futures this morning, however, looked pretty hesitant as many investors want to be bullish. But with inflation data and all these global risks incoming, no one wants to stick their neck out.
Yeah, Zane, and bonds gave a lot of mood today, as in the US yields pulled back Friday and a classic safety bit behavior. Meanwhile, over in Europe, the spread between French and German bonds widened as it's all about the politics that go on within those countries. When France wobbles, you don't just have a French story, you have a eurozone story. And on top of that, oil's soft with OPEC plus signaling more barrels are coming. So mixed signals, but underneath it, we could feel more investors getting defensive. Now, let's dive into France first. Brock Swan Bayrou, sorry if I mispronounced that, the prime minister faces a confidence vote. And if he loses, the government could collapse. And that meaning that either new elections or a caretaker setup. Now, political gridlock in France isn't unheard of, but this time is very much dangerous as the bigger European backdrop, slow growth, energy headaches, and higher defense spending. You don't want political dysfunction layered on top of that.
And the bond market already showed you how nervous it is. French yields spiked late last week. Investors immediately started thinking about contagion. Will this spill into Italy, Spain, even Portugal? And a lot of you guys might be thinking, what does this have to do with, the markets over here in the US? But, everything is interconnected on a macro global economy scale. So what happens in France, what happens in Italy, Spain, Portugal, it's all going to affect over in the US over here too. So you look at the euro, which slid against the dollar. When confidence weakens in Paris, it weakens in Brussels too. Europe needs cohesion, especially when NATO trying to stay united on Russia and Ukraine. A shaky French government dilutes Europe's ability to project stability.
Yeah, I agree with you, Zane. The macroeconomical trends that you brought up are exactly right. And the deeper issue here is the credibility within the country, as France isn't just a member of the state, it's a core pillar alongside Germany within the EU. If you have gridlock in Paris, fiscal reforms slow down, and the EU level decision making gets much harder. And suddenly, Europe looks very much confused. That perception matters almost as much as the policy itself. Once investors smell fragmentation, they start hedging, and the euro becomes collateral damage.
And now the second big rundown we should go through is OPEC. They announced they'll add about 137,000 barrels per day in October, and that's for the oil supply. On paper, that's a rounding error in 100 million barrel per day market. But the symbolism is what counts. It tells you the group is tilting towards loosening supply, even with demand growth slowing.
Yeah, Zane, as the demand is really softening down, China's industrial output has been very sluggish as the global tensions are squeezing manufacturing and inventories within the US and Europe, which are already high. If OPEC Plus floods even a little more supply within the environment, you're looking at Brent drifting lower, maybe into the mid 50s. That's really good news at the gas pump, but very bad news for energy companies and worse for petrostates that depend on oil revenue to balance their books.
Yeah, Roman. A lot of people, I guess, would just look at the gas price go down and be like, "This is amazing. The economy's going great," but that's not always the case, is it?
Not quite.
Um, So let's talk about Saudi Arabia and Russia. They are really the drivers here, and they both all need the cash. Saudi has Vision 2030 to fund, and Russia is burning through resources to keep the Ukraine war machine going. They're not thinking about the next 6 months. They're thinking about locking in market share before renewables and EVs eat into demand. But here's the paradox: if they oversupply now, they're going to risk undercutting prices so much that their own revenues would fall. It's a very delicate business.
Yeah, Zane, and this comes as geopolitics and economics are colliding once again. Oil isn't just a commodity, it's a leverage within the world. If Brent holds in the 60s right now, OPEC feels very powerful. However, if it slips in the 50s, consumers breathe easier, but Moscow and Riyadh are feeling fiscal pressure as that could change their behavior on the world stage. So this isn't just about filling up your gas tank every so often. It's about global diplomacy being shaped out by barrel counts. And the third big story today that we have for you is corporate debt insurance. As in the first week of September, companies sold over 65 billion of bonds, and 56 of that was just investment grade. That's one of the busiest starts to September on record, as CFOs aren't wasting times and they're raising capital while demand is still hot.
Yeah, Roman, investors are really snapping it up because they're hungry for yield, and treasuries feel like a moving target with the Fed in limbo. What's fascinating is how this reflects a split view. Corporations don't issue like this if they expect a near term collapse. They're signaling some confidence in their outlooks, which is real good. At the same time, they are hedging against the possibility that financing costs rise if spreads widen or if the Fed drags its feet on rate cuts.
Yeah, Zane. And to think about the uses of that cash, some will refinance debt, some will fund some acquisitions, and some will go straight into stock buybacks, as the micro decisions will definitely ripple out. If assurance keeps flooding the market, investor demand might not keep up, and that might mean higher borrowing costs. So, ironically, the very act of rushing to the issue could push the cost of the capital in the higher weeks ahead.
Yeah, it's also about telling investor psychology. People are buying bonds like crazy, not just because they want yield, but because equities look shaky with all this geopolitical noise. So corporate credit is becoming the middle ground. They are riskier than treasuries, but they are safer than stocks. So it's that kind of middle ground right there. That dynamic can last for a while, but if corporate spreads widen too much, you're going to see money flow back into sovereign debt. So let's tie this all together. What I see across all three stories, as far as France, OPEC plus, and bonds, is a question of confidence, and that is generally, usually, always the question. Political confidence in Europe is shaky right now. Confidence in oil demand and supply discipline is under review. Confidence in corporate America's ability to finance itself is being tested, and confidence is what drives markets more than raw numbers.
Yeah, and you can see that in the decision making at the micro level as well, as a French manufacturer is asking if he should hedge the euro exposure today. A US airline is debating whether to hedge a jet fuel at $80 a barrel or gamble that prices fall. A Fortune 500 CFO is deciding whether to issue bonds now or risk waiting. The macro headlines force those into micro decisions, and those decisions circle back into the macro pictures. So that's why the markets feel so jumpy right now. So that's unfortunately all that we have going into this week, as France's vote could definitely shake up Europe. OPEC barrels could definitely tip oil prices lower, and corporate bonds will tell us just how much appetite investors still have to risk. None of these stories end today, as they're setting the stage for the rest of September.
Yeah, exactly, Roman. It's one of those weeks where you need to watch not just the outcomes, but the second order effects. What happens to spreads if France wobbles? How do equities react if Brent hits 52? Does bond issuance keep flowing or hit a wall? Those are the signals we'll be watching.
Yeah, Zane, and thank you for starting your week with us, as we'll be back tomorrow, and follow at Before the Bell with Roman and Zane on TikTok and Instagram for our daily clips and updates. And just to remind you, none of this is financial advice, as we are just a few students that are trying to have a broader outlook on these problems. And we will be back tomorrow to break down the US inflation data and how the market digests today's headlines.
Until then, stay sharp and stay tuned. Appreciate all the support, and we're going to bring it back home to the US tomorrow.